This year, also one that's a little bit contentious perhaps, PDD Holdings. What do? Well, it's a holding company which operates two mega online marketplaces. Pinduoduo is the marketplace in China, and internationally they operate through the platform Temu. Some people also call it Temu, but I see the company itself has changed the pronunciation to Temu more recently. Temu is an online marketplace platform that's available in 86 countries outside of China, and they follow a consumer-to-merchant business model. So this is quite interesting and maybe something to explain. So if you think about a traditional online marketplace, they sell to consumers, which means they charge consumers, so the revenue comes from consumers primarily. In the case of Pinduoduo, they flipped that model on its head, and they effectively charge the manufacturers, the suppliers, the merchants, advertising fees, listing fees, and that is where the majority of the revenue comes from. And historically, that is where almost all the revenue came from in the case of Pinduoduo, the Chinese platform that they operate. More recently, it has become a two-sided marketplace. So they are making money both from merchants, as they have in the past with the consumer-to-merchant model, but they are making money now also through Temu by charging transaction fees and other fees to the actual user of the platform. So they make money from both sides, but they started as a consumer-to-merchant business model. The company has a market cap of $135 billion US. So this is not a small company. That's why a lot of investors might have heard of it before. They have a December year end. They're quite secretive, which is quite interesting, and I think has scared a lot of investors away. It's difficult to really come to grips with this company and to say authoritatively that you really understand what PDD Holding does, where it makes its money. So we'll talk about that in a little bit more detail later on in the presentation. Very strong valuation metrics. On the face of it, it really looks like a great opportunity, but as usual, one needs to dig a bit deeper. The company PDD Holdings is registered in the Cayman Islands, which is quite common for Chinese listed stocks. A lot of what we call, or Western investors might call, Chinese stocks are actually Cayman Island stocks, if you think about the domicile. They are headquartered in Ireland, also not that strange. A lot of companies, for tax reasons, have got headquarters in Ireland with only a handful of employees actually operating in Ireland for efficient tax reasons. And for a global online marketplace platform, that's also not uncommon. They functionally operate from Shanghai in China. That's where the vast majority of the employees work. And then they have these depository shares listed on NASDAQ. So quite complicated. And again, this complexity might have scared away some investors. And we'll talk a bit again about the typical Chinese stocks that are Cayman Island domiciled, but use VIE, variable interest entities, to give investors exposure to the Chinese economics. We'll get to that. PDD Holdings was founded by Colin Wang. He's an ex-Google engineer. It was founded very recently, 2015, as Pinduoduo, the Chinese social buying platform. And they initially focused on agricultural products. So what they brought to the market, which was different because at the time there were these big incumbents like Alibaba, JD.com, is they brought group buying, which led to really very attractive prices if a few consumers banded together by creating a valuation group, the ubiquitous chat platform in China, valuation, or WeChat as we call it in the West. And then combined with that, you can call them Disney-like features, gamification, making it fun to purchase on the Pinduoduo platform. And they did really well in combining, you can say, and the founder, Colin Wang, has said, it's like Costco plus Disney. So great prices, great value for consumers, the Costco type model, but combining that with the gamification of a Disney type entertainment, and that very rapidly took market share from the likes of Alibaba and JD.com, and it meant that Pinduoduo grew very strongly with this agricultural products focus. And then from there, branched out to other products. Firstly, also in the lower tier cities in China, tier 5, tier 4 cities. But slowly but surely, and they're still continuing on this path, moving towards third, second, first tier cities, and moving on from agricultural products to, well, cheap and nasty products, but more recently, even branded products. And there's no official data on this, but I've read a few transcripts with ex-employees and some other websites which claim that it could be that Pinduoduo is the biggest seller of Apple iPhones in China. So that gives you some idea that where they started in agricultural products versus where they are now in terms of branded products shows how they've moved swiftly towards higher value branded products. On the back of this growth, they launched Temu in 2022. Again, less than 3 years ago, in a very short space of time, moved into 86 countries, and it's taken the world by storm. In the US, they had these ads at the Super Bowl. At one time, they accounted for at least 1% of all Facebook ad spend. They're a significant spender of Google AdWords and advertisements on Google. And that means that at the beginning of Pinduoduo and beginning of Temu, these were loss-making platforms because so much was spent on marketing. More recently, these platforms are very, very profitable as they scale down the marketing a bit and then generated more profits from the merchants through this consumer-to-merchant model. And Temu is still growing strongly. Some of the countries which they entered early in 2022 have definitely seen a tapering off of new users, but it's still, if not the top downloaded app in the market that they operate in the top 5 at least, in terms of the most popular app in the countries that they operate, in the 86 countries that they've entered. So really growing very strongly and just very, very quick adoption by consumers. Now, everything I've said so far is very positive, but it must be said that there is some controversy surrounding PDD holdings. So one needs to consider reasons not to invest rather than just the reasons to invest, and we're going to do that. So the reasons to invest, I could put that on one slide, and there's a valuation slide coming up, but very simplistically, this is a company with very strong revenue and profit growth over the last few years. It's an asset-light business. It's got high returns, a high net cash position. A third of the market cap is in cash at the moment. So no net debt, a net cash position with a third of the market cap in cash. That's unbelievable. So remember, 130 odd market cap, they've got roughly $40 billion in cash on the balance sheet. It's a question whether that cash is in China or outside of China. Again, they don't disclose this. And it's quite important to consider that because China has got foreign exchange restrictions, which is something we as South Africans are also aware of. And that means one needs to keep in mind that just because you see a big amount of cash on the balance sheet doesn't mean it's distributable. It is probably a large part of that is restricted. And they do say in their SEC filings what the restricted portion is. It is roughly half of the cash at the moment. It's got a December year end, so we are due the latest filings for the December 2024 financial year in April 2025. So that will give us the latest figures. But probably around half the cash, and it might be a little bit more than half the cash now, is restricted. So just keep that in mind. And again, that might have scared off investors because in the face of it, having a third of your market cap in cash just looks very attractive. High cash generation, high return on capital employed, high ROEs, the last few years above 30%. So very strong financials. They've proven their ability with Pinduoduo. They've proven that they can come from nowhere, take on these incumbent online marketplaces and win market share and really resonate with users. And they are repeating the success with Temu. As I mentioned, they are now an attractive two-sided marketplace. And this concept from the Nomad partnership, scale, economies shared, this is the business model that they follow. They get scale and then they reinvest that scale back into the business to offer even a better product to both the user through lower pricing, and the merchant through helping them to find users that want their products and to stimulate demand for the product so the merchant can benefit from increased volume and production planning. So a really good example of this concept of scaled economies shared. They are still continuing to gain market share from these incumbent online marketplaces. I mentioned Alibaba in China with Taobao and Temu that they gain market share from and from JD.com. But now in the US, they are gaining market share from Amazon.com. And Amazon has launched a new app in the past year called Haul, Haul, to sort of take on Temu with these low-value items that are shipped directly from China. So that's an interesting fight, but PDD is gaining on Amazon. And again, I didn't clarify this, but in this online marketplace, what helps PDD to keep the prices so low is they cut out all the middlemen. They link the merchant in China directly to the consumer wherever they might be in the world, cut out the middlemen, sometimes multiple middlemen, and that means lower pricing, but still very good customer service by the items being shipped individually by those merchants then to the user in whichever country they are in, with PDD assisting with the logistics, taking a fee for that, obviously. The founder, Colin Wang, still owns roughly a quarter of the company. At one point last year, it was announced in the media that he was China's richest person. But soon thereafter, there was the third quarter earnings call from PDD, which was shockingly negative. And the share price fell almost 30% in the 2 days of that earnings announcement and earnings call. So Colin was not the richest Chinese person anymore. And we'll touch on that again. So the bottom line is, looking at these reasons to invest, that on the face of it, PDD seems like a no-brainer. But why? Why does the opportunity exist? Why does this no-brainer $130-odd billion company exist? Well, there are numerous reasons for this and why investors have decided not to invest in PDD, despite this apparent opportunity. So we're going to invert the question, and we're going to investigate and see if we can gain comfort that the reasons not to invest in PDD are not sufficiently persuasive. And if we can persuade ourselves that the reasons not to invest are not strong enough, well, the only alternative left mean, well, why not invest? And that's basically the approach I'm taking. So before we get to those reasons not to invest, let's look at the valuation. I mentioned previously that Protea Capital Management uses a Quantamental investment process. So we do some number crunching, and then we show the output as a graph, which is quite intuitive, where we superimpose the share price, which on this graph is the gray line, with our different ways of working out valuation. We have different earnings-based valuation models. There's a ROE-based earnings-based valuation model and a return on capital employed-based valuation model as well. We do an EVA, economic value added valuation model as well, which is the shaded area, so the top border of the yellow shaded area. And we also show the tangible NAV per share, which is the blue shaded area. And we put that all on a graph. And by looking at this picture, it allows us to very quickly see gaps between price and value and identify companies which are increasing their intrinsic value by either maintaining or increasing their moat, and therefore becoming more valuable as time goes by. And we see this picture with PDD. We see a company that is growing in value. It is enhancing its moat. The share price was in bubble territory in 2021. You can see the spike in the gray line, but it has since come down. The company has increased in value, but the share price has come down even further in the past year. So it's trading below its earnings-based valuations, our earnings-based valuations. It's trading in line with its EVA valuation, but now very importantly, according to our assumptions, we can see that this EVA-based valuation and the earnings-based valuations are going to increase year after year into the future. So by plugging these assumptions into our quant models, we get a projected fair value of PDD shares in 4 years' time. Our default is the 4-year forecast period of $240 per share. It's trading at roughly $100 per share at the moment. So that gives one a 4-year compound annual growth rate of 25% per annum. Quite attractive. I also show the EPS growth here. So if you plug in our assumptions, which is a 20% revenue growth and fading the net margin from 25% where it is currently to 22%, the EPS growth comes from the expected $11 per share to December 2024 to $18 per share in December 2028. So that's a 4-year CAGR of 13% per annum. So we expect that PDD will grow its earnings by 13% per year, but because the shares are too cheap, they are trading at too low a multiple, we think that the shares can return 25% per annum just by the company reverting back to a more relevant valuation metric, a more relevant multiple of earnings. So if our assumptions pan out, this could be a 25 per annum share over the next 4.